Hello everyone, welcome back, Epic here. Not too long ago we talked about CBDC. We explore maybe more in depth as to what is CBDC, uh, what are some of the challenges it pose, what are some of the risks that factor we need to consider, and we talked a bit about how back in March of 2020, where the pandemic was declared, and slowly thereafter we had maybe 20 or 30 country starting to look into CBDC, and here we are, uh, September of 2022. We now have well over 123 countries working together on this CBDC and changing from traditional finance to new finance. And today I want to share this video where the, this conference took place in France, September 27, where they talk about all these central banks gets together and they discuss and talk about important topic here for today, that is tokenizing of finance. And this is where the central bank from EU, central bank from America, the Fed, uh, they say some very important things that impacts this financials, new financial system that's to come in near future. And he also talks significantly about regulation as it relate to stable coins, DeFi world, in crypto currency. So with that, let me share this video. Enjoy. I think it's one of those street where if you're a finance junkie like I am, then I think you'll enjoy what these central bankers have to say and their thought process around what's to come, in my opinion. So anyway, enjoy.
Bonjour. Hello to everybody. Ladies and gentlemen, bienvenue à Paris. Welcome to Paris and to the Banque de France, even if you are not exactly in our premises, which are quite close to the Louvre, but we decided to organize this conference here because you are so numerous and the Louvre is so prestigious. It's a great pleasure to welcome you for this conference we organize at the Banque de France. I am honored by the presence online of Commissioner Mairead McGuinness, of my most distinguished peers and central banks, and let me have a special welcome for my friend Agustin Carstens, General Manager of the BIS, and of several prominent representatives of the public and private sectors. I trust this unique blend of skills will offer a comprehensive overview of the topics that will keep us busy, the tokenization of finance and the role of central banks in it. Let me just recall what I sometimes describe as a triangle of disruptions: new players, new settlement assets based on blockchain, and new decentralized market infrastructures. These disruptions offer clearly the potential for cheaper and faster services. However, they could also lead to fragmentation and systemic risk. How can we collectively reap the net benefits from innovation? That will only be possible if we come out on top of two false contradictions. The first apparent oxymoron opposes stability and innovation. Financial stability implies that the financial system is capable of withstanding shocks so as to avoid impacts on the real economy. But financial stability does not mean stagnation or paralysis, and does not ban innovation in any way. On the contrary, financial stability creates trust, which is an imperative for innovation to last. well-tailored and consistent regulations are key in this regard. The second false or apparent contradiction opposes public and private players, with the former supposedly conscribed in the conservative regulator's role and the latter in the innovator's role. Central banks may sometimes consider this caricature as unfair after decades of developing and maintaining state-of-the-art technologies. To private players who know us better and to others, you can rest assured that we are willing to continue our fruitful partnership. We will obviously have to reinvent the terms and conditions of that partnership to some degree. But let me stress that central banks' action will only succeed together with you, not against you. And that we central banks need to be on both sides, regulation and innovation. I will now elaborate on these two key issues, started with regulation. A number of players in the crypto world have recently stumbled. So-called stablecoins, DeFi protocol, lending platforms, hedge funds, demonstrating in practice what many regulators and central banks had been claiming for years, that these new tools of payments and finance had unlocked old-age dangers, meaning that the industry requires robust regulation. But the so-called crypto winter is no reason for complacency or inaction. Europe has been a pioneer here, designing and drafting a new regulatory framework known as MiCA, Markets in Crypto Assets, that is tailored to new assets and players. I can only hope for its swift formal adoption as early as March next year, as well as the adoption of the very welcome agreement on the extension of transparency and anti-money laundering rules to transfers of crypto assets. Other major jurisdictions are less advanced at this stage. We should be extremely mindful to avoid adopting diverging or contradictory regulations or regulating too late. Crypto players operate globally, and even their place of establishment is sometimes difficult to determine. We are nevertheless fortunate to have a common international framework facing an international industry. The G7, as early as 2019, under French presidency, by the way, then the FSB and the G20 have made great progress in this direction. By the end of this year, the FSB will publish updated high-level recommendations. This success shows that regulation of crypto players and crypto assets, and more broadly, regulation of payments, is one course of action where what I would call a pragmatic multilateralism or focused multilateralism can and must still deliver. But to avoid further payment fragmentation, there are two imperatives. First, let us keep coordinated. I am sometimes impressed by the growing number of international bodies which play in the crypto regulations orchestra. We need a strong and a single conductor, and that should be the FSB. Second, let us implement in all jurisdictions. The current moment calls less for further global reflection or ever refining of taxonomies of financial tokens, and rather for decisions and the monitoring of basic, consistent, and robust national regulations. Let me come to innovation, as part of central banks' response, and central banks have here also their own driver's seat. Digital technologies are profoundly transforming finance. And for sure, we will see a significant development of tokenized and decentralized finance. Our stance at the Banque de France is both to support regulatory reform, I insisted on that, and to play an active, innovative role. We have been using blockchains for several years now. As early as 2017, we were the very first central bank worldwide to implement a blockchain solution to manage a repository of creditors. I will come later to our CBDC experiments, but we developed there our own permission blockchain called DL3S, Distributed Ledger for Securities Settlement System. We have also drawn on artificial intelligence for various uses, such as a new forex tool, trading tool, and supervisory tools. The question that now attracts public attention is whether central banks' investigation phases will lead to the development of CBDCs, central bank digital currency. Almost all of that attention is focused on retail CBDCs. At the same time, we can sometimes hear, and not only from commercial banks, that they are a solution in search of a problem. In my view, let me clearly state it, this phrase simply misses the point. What we are currently doing is keeping our eyes and minds open on this new way of making public money available. In Europe, we are halfway through our investigation phase. The Eurosystem will make its decision by the end of 2023, before a potential launch in 26 or 27. I am sure ECB President Christine Lagarde will later in this conference be able to shed some light on the project. Let me only stress one thing: such a digital euro could and should be decentralized in its implementation in the spirit of public-private partnerships I mentioned earlier. But let me now come to the other side of the mountain. On each mountain, you will always find a side that is less exposed to the sun. Here, this northern face is wholesale CBDC. It currently attracts less public interest, although it poses relatively less complex legal issues and has two strong business cases. First, a wholesale CBDC could significantly contribute to improving cross-border and cross-currency payments. Following a first report delivered to the G20 in July last year, the Future of Payments Working Group of the BIS, dear Agustin, has recently finalized a new report outlining options for access and interoperability of CBDCs for cross-border payments. Second business case, a wholesale CBDC could accompany the tokenization of securities as a safe and liquid settlement asset for them in a blockchain technology. Failing to offer market participants a wholesale CBDC could open the door to an extensive use of so-called stablecoins, which would pose a systemic risk. Therefore, over the past 2 years, the Banque de France has been looking into a wholesale CBDC with a view to contribute to Eurosystem's efforts in designing and developing it when the time comes. And this time could come sooner than expected, with the upcoming entry into application of the so-called European pilot regime in early 2023, less than 6 months from now. This new regulation offers a unique opportunity for the Eurosystem to conduct its own pilot regime in close cooperation with private players. Without over-promising on that pilot wholesale CBDC, we have to seize the opportunity to try out various solutions from next year onwards. Learning by doing is the best way to acquire knowledge. In that spirit, the Banque de France has been conducting, since 2020, 9 experiments with a wide range of partners, and we reported in a publication last November about our first results. Considering these promising results, we have decided to launch a new series, I announce it today, of 3 experiments. You will learn more on them in the coming weeks, but let me already give some insight today. 2 of these experiments focus on improving cross-border payments, the first business case I mentioned. By working on interoperability between CBDCs with innovative solutions, such as a liquidity management tool based on decentralized finance technology, AMM, Automated Market Maker. The third experiment aims at deepening previous ones on the use of central bank money as a safe settlement asset for tokenized securities, the second business case I mentioned. We will do it together with other European partners. It involves issuing and distributing tokenized bonds on a blockchain. Let me conclude by recalling some moment of French history. Here in the Louvre, in 1980s, it was decided to design and build a large glass pyramid, which you could admire, in its courtyard of Le Louvre. The French citizens, the older ones at least, remember that this disruptive architecture by the famous architect Powell was first met with outrage, as critics considered it incompatible with classical style. It was nonetheless built and hence has since then become a new cherished symbol of Le Louvre. I hope that we central bankers will find our way to make digitalization fit in the existing architecture while regulating it to the extent necessary. Thank you for your attention, and I would now like to hand the floor over to Commissioner Mairead McGuinness.
Merci beaucoup. Bonjour à tous. J'aurais aimé être à Paris avec vous aujourd'hui, mais je suis à Bruxelles. So firstly, good afternoon, everyone. Thank you, Francois, for both the invitation and particularly for your wide-ranging opening remarks. You talked about trust in the very beginning of your speech, which I think is so important. And I think your linking to the architecture at the end of your speech was very, very correct and well said. The one thing that I really want to emphasize, which you already have, is that regulation and innovation are not in conflict, because regulation and innovation should work hand in glove. And if we take the broad example of the single market, by legislating and regulating at a European level, we enable a new business to start up in a member state but easily expand to another, or indeed a financial institution authorized in one country to finance a company based in another. So rules and regulations underpin a single market that offers both opportunity and security to customers and businesses. In contrast, the area of tokenization has often been described, and you will know this, as a Wild West, a lawless place full of risks and dangers. And I have to say that those lawless days are coming to a close. By bringing in rules, we want to guard against those risks and dangers while allowing us to harness the possible benefits. So today I want to address what tokenization might mean for the financial system, how we are responding to those changes with regulation, and how the public sector, and in particular central banks, might complement what we are seeing in the private sector. So firstly, the challenges and opportunities. Tokenization started as a challenge to the existing financial system. It emerged from a desire to disrupt. It was about bypassing the traditional financial system, seen by some as stacked against the man on the street. And I think it's no coincidence that the Bitcoin network started operating in 2009 against the backdrop, if you like, of the financial crisis and the distrust of financial institutions that resulted from that crisis. It's also perhaps no surprise that crypto markets have exploded since. Crypto markets, as you know, are extremely volatile. But overall, they have expanded to a global market capitalization of around €1 trillion. And behind all of this is blockchain technology. This technology does have potential. It cuts out the middleman, removing the need for centralized processes and intermediaries. It can make transactions more efficient and transparent by recording key information in an unchangeable format, making it accessible to all market participants. And this could make payments cheaper, faster, and safer. This technology could also unlock the billions of euros and dollars currently used to cover credit or settlement risk in the financial system. But these potential benefits cannot emerge in a Wild West scenario. Without regulation, crypto poses big risks for the system, for our financial system. Crypto markets are growing in size and popularity, so we need to think about their systemic risk. In February this year, the Financial Stability Board warned that crypto markets have the potential to grow into a threat to global financial stability. And we need to take those warnings very seriously. And even if crypto markets do not yet present systemic risks, they already present many other risks. Earlier this year, a number of larger crypto projects collapsed, including supposedly stable coins, laying bare the lack of supervision. We know that consumers risk buying into unsuitable products because they're often lured in by a false promise of value going up and up and up. Investors risk losing money because of crypto's volatility, and we know many have. They can also lose through deception and/or fraud. The Financial Times recently reported about the boom of crypto fraud alongside the boom of crypto markets during the pandemic. And they reported that one of the best ways for a victim to recover at least some of their losses is, perhaps ironically, through their bank. Banks are regulated financial institutions and so are subject to prudential rules as well as rules to protect their customers. Crypto also poses risks relating to money laundering and sanctions circumvention. This year, the US Treasury's Office of Foreign Assets Control has sanctioned 2 currency mixers because certain state-sponsored hacking groups, which help their government evade sanctions, have been using these mixers to launder money stolen in cyber attacks. And all of that means that there is a clear and urgent need to regulate and supervise crypto markets. So the Commission is doing a lot of work to regulate crypto markets and allow them to develop on a sound basis. One of the first steps we took was to create a pilot regime, which, Françoise, you've referred to. And this is for securities trading and settlement on distributed ledger technology, or DLT. So I'm very happy this pilot has entered into force and can be used from March of next year. This is all about allowing innovation and experimentation, but within a safe environment where the citizen is protected. The distributed ledger technology, DLT pilot, aims to develop secondary markets for tokenized financial instruments, where market participants can experiment with trading, clearing, and settling securities using DLT. This pilot aims to identify ways to improve efficiency. It could make it possible to merge trade and post-trade processes currently being provided by different market infrastructures. Financial firms will be able to apply to their national supervisor to get permission to run on DLT market infrastructures and to get temporary exemptions from specific EU trading and post-trading rules. If granted, they could then trade and settle a broad range of securities on DLT, subject to certain limits. And I would encourage all companies and supervisors to make use of the opportunities in this pilot to learn and to experiment. As you've already said, to learn by doing. It's an example of this idea that good regulation enables innovation. And it's a demonstration of how the European Union is supporting efficiency on financial markets, something we want to encourage as we develop the Capital Markets Union. The second major step we've taken is the proposal for regulation on markets and crypto assets, or MiCA. The Parliament and Council reached a political agreement on this regulation in June, again at the end of the French presidency of the Council of the European Union. So a big appreciation to my French colleagues for this substantial volume of work. The whole thinking behind MiCA is to support a crypto asset market and allow innovation, but to do so on a sound basis and addressing the risks I've already mentioned. So we want to root out the bad actors. We want to provide the consumer and investor protection that just doesn't exist in this area yet, and to set rules for crypto asset service providers. MiCA will bring crypto markets into the regulated space. And under MiCA, the crypto asset service providers will be subject to both prudential requirements and rules of conduct. It will also require actors in the crypto asset market to disclose information on the environmental and climate footprint of crypto assets. Crypto markets will be supervised by regulators that will be able to intervene if there is any evidence of market abuse or activities that may lead to financial instability. So this regulation would mitigate against the kind of turbulence we saw earlier this year for so-called stable coins. It sets out strict requirements on establishment, authorization, and reserve management of any tokens, which refer to an official currency or a basket of assets. That includes EU direct supervision for the so-called e-money tokens and asset reference tokens that are systemically important. Central banks and the ECB, as well as the EBA and ESMA, will have important roles to play in this new regime. We've also extended the transfer of funds regulation to the virtual and crypto space. Just before the summer, the co-legislators reached agreement on this regulation, setting new rules for transparency of crypto transfers. And this will bring much needed transparency to these transfers, helping to address a new vulnerability in our fight against money laundering. These rules will enter into force at the same time as the MiCA regulation. While addressing risks in the crypto asset market, MiCA and the transfer of funds regulation will give legal certainty to market participants and promote innovation in the single market within a framework of clear rules. Service providers will need to be authorised in the European Union. But once they have that authorisation in one member state, they will benefit from our financial passporting system to offer their services throughout the EU. And indeed, the EU is among the first in the world to design such a comprehensive regulatory regime for crypto assets. And I do believe this regulation will allow crypto markets to develop on a sound basis. We hope that European firms will take advantage of both these pieces of work, the DLT pilot and the MiCA regulation. While it is noteworthy and good that Europe is a trailblazer on crypto regulation, it's also important to recall that crypto markets are global markets. And that means we need international coordination. And that goes too for decentralized finance. Decentralized finance is all about providing financial services without a central intermediary, like a bank or an exchange. And all of this challenges both international standards and EU rules that tend to be based around entities. In fact, it challenges some of the fundamental aspects of the financial system as it currently exists. And here in the Commission, we're monitoring the developments and risks in this fast-moving area very closely. Central banks, and indeed we've heard already, have not been idle throughout these many changes. One of the main roles of central banks is, of course, to issue physical cash and oversee the monetary system. So central banks are carefully watching and analysing the consequences of money and transactions moving online. And central banks are centre stage when it comes to central bank digital currencies. And the Atlantic Council reports that over 100 countries are exploring a central bank digital currency. Just 10 have fully launched a digital currency, including Nigeria, one of Africa's fintech powerhouses. And indeed, I know that Banque de France is very active in this area. We've worked on cross-border projects, or rather you have worked on cross-border projects with Switzerland and Singapore. And you're also involved in the digital euro project. So let me just say a little about the digital euro. We in the Commission are working closely with the European Central Bank on this project. In a digital world, the digital euro would provide a public money alternative to private means of payment and as a complement to cash. It would offer additional payment options to people and businesses across Europe, new options for online payments, offline payments, peer-to-peer payments, and many more. And it would be a complement, not a substitute for private initiatives. The digital euro could be significant for people and businesses, and we need to thoroughly consider the possible consequences and, of course, to consult as widely as possible. And this all led the Commission to conduct a targeted public consultation, in addition to the consultation work already undertaken by the ECB, and we undertook our work in 2020. We got a lot of responses to that call from citizens and businesses. There are many important questions to consider, and this will all be informing our progress on this project. I think it's fair to say that the Digital Euro project was met with a lot of interest and support, although some financial institutions were asking about the potential impact of a digital euro on their business model. So some examples that were raised, several respondents pointed to the risk of disintermediation of banks and financial stability risks. There are big risks that we need to guard against, and we should also look at the role of private market participants in the distribution of the digital euro. Some who responded felt that the digital euro should focus on complementing what's already on offer by the private sector, while others saw the potential for new innovative features, like machine-to-machine payments or programmable payment functionalities. All respondents concurred that people-to-people and offline payments would add the most value for users, mirroring cash payments. Privacy was a big concern for citizens who responded to our consultation, so we would need to provide privacy while balancing that with the need to address the risk of money laundering. And we should also determine whether the digital euro should be granted legal tender status, like euro cash, or not. So in the Commission, we plan to propose legislation for possible digital euro in 2023, and this will lay down the principles for the digital euro. And the European Parliament and Council will then have the opportunity to debate and amend our proposal. And this legislation would be necessary, a necessary step before the potential issuance of a digital euro by the ECB. And I know Christine will speak about the ECB's perspective on the digital euro project later today. Earlier, I mentioned that over 100 countries are looking into CBDCs. That makes international cooperation absolutely essential in this area, as well as in crypto and decentralized finance. And I welcome that the G7 has laid down a set of principles for central bank digital currencies, which we will be sure to follow. So in closing, the evolutions we're seeing in the financial system are fast moving and represent a whole new ecosystem. And so our regulatory measures, we're acting in a way and thinking in the same way. We need to build a new regulatory ecosystem. The MiCA regulation and the DLT pilot will bring crypto into the regulatory and supervisory fold. A digital euro could complement private initiatives in this area. And meanwhile, we're keeping the growth of decentralized finance under careful review. This new ecosystem holds both opportunities and risks for financial firms, the financial system, and the wider society. So we need to address the risks if we want to benefit from the opportunities. But I think all of us here today are certain of one thing. The old ways of finance and banking are already being overtaken by new, digitalized means and solutions, rules and regulations are essential and must be tailor-made to meet this fast evolving and exciting area. Thank you.
Thank you. Thank you very much, Mayred. As you speak wonderful French, merci beaucoup. And if you allow me 2 words of European pride, Europe is seen as complex, and it is indeed in its architecture, but it's very good to see how we can deliver on regulation. And second, Europe is not seen as especially innovative, but it's good to see that at least on CBDCs, and we'll come back to it, we are possibly on the front line. Thank you very much again, and I now turn to our first roundtable about how should central banks address financial stability challenges related to decentralized finance. I don't need a long introduction. We are all aware that there was, for years, this challenge of accelerated technological disruption, and there is, in the more recent past, the additional challenge of monetary normalization, and we saw that the change of monetary policy has exposed weaknesses in the crypto asset ecosystem. We are lucky enough to have an outstanding panel to address this difficult question. And may I welcome online 3 of our participants. First, you see probably, I see Christine Lagarde already on screen, and we will see probably Powell in 1 minute. They are the 2 leading central bankers across the Atlantic. So, bonjour, good morning, Jay, because it's very early for you. Welcome to both of you. And we also have online a 3rd central banker from Asia, Ravi Menon, Managing Director of the Monetary Authority of Singapore, and by the way, a very innovative central banker. Ravi, good evening for you in Singapore. And last but not least, but Agustin, I already welcome you, the General Manager of the BIS, who is, so to say, the central banker of central bankers, if you accept this image. 1 word about the way we will proceed. We have about 1 hour. First, we will try to look briefly at the global view on financial stability and decentralized finance. It will be introduced by Agustin Carstens, and then I will ask Jay, Ravi, and possibly Christine if they want to react on this first part. And then we will have a second part, which will be the longer one, on the responses of central banks, be it on innovation and or regulation, and Commissioner McGuinness and myself mentioned these 2 important pillars, and it will start with Christine and then Jay presenting the European and then the American view on the issue. Agustin, if you agree, let us give in 5 minutes the global view on financial stability and decentralized finance. And we all know how accurate you can be on such a sensitive issue.
Very much. Thank you for having me here. It's a real pleasure to be in this grand event prepared by the Banque de France and in this magnificent fora. This is a very timely discussion. Of course, we have been facing some circumstances recently that has put financial stability issues at the top of our mind. And in addition, we have seen very important developments in the field of DeFi. And as you said, we just witnessed a few months ago what you called the crypto winter. Financial stability issues, of course, are very important, and we have to assess the impact of DeFi into financial stability. Let me start very briefly without going on too long. We started with crypto assets, cryptocurrencies, Bitcoin, generally speaking. Problem there, major volatility, instability, lack of stable pricing. Next iteration was stable coins, which try to address the issue of instability of cryptocurrencies. And then based on using crypto stable coins, the idea has been to use different decentralized protocols and consensus mechanisms plus cryptography to further the application of digital assets to financial transactions. Therefore, DeFi has been created. I have to say it has been a quite unruly development. It has developed in a very, I would say, laissez-faire way. And and one of the big problems that DeFi has, as we know it today, is that it's basically the applications of some cryptocurrencies with some other financial transactions that are self-referential. They really are not tied to real-life transactions or need. I mean, they facilitate borrowing, lending, and trading, but it's mostly only cryptocurrencies. And it is based on, so DeFi depends and exposes intermediaries to the traditional risks that traditional financial intermediation establishes, which is liquidity risk, counterparty risk, leverage, and so on and so forth. But they don't have the infrastructure to deal with that. Basically, the way they have dealt with is by collateralized arrangements, and that's why stablecoins is the grease on the wheels in DeFi. But oftentimes, the collateralization is not effective. The governance of many of these DeFi transactions are not well established, and they depend to a large extent on exchange houses that do too many things at the same time without appropriate segregation of activities, accountability, and appropriate governance. This leads me to, I would say, the punchline of this initial intervention, and that is that DeFi has today many structural problems that in a way, what we have seen today was not hard to predict. I mean, it was, and we at the BIS in different documents established there are intrinsic weaknesses into the system that haven't been taken sufficiently, and therefore it's not surprising that we have seen some stability issues in that sector. This has been compounded by the movement of interest rates, but I won't say that the movements in interest rates has been an additional element, not a key element of the problems we're seeing in DeFi today. Now, that doesn't mean that the technology that is behind DeFi is not useful, that the ideas are not challenging, and challenging more in an intellectual way, that we need to think about it and that we should find ways to make good use of them. But what I see is that the development of DeFi is going in one direction, and what we all would like to see from a financial stability is going in another. Therefore, we need to close that gap. We need to work more together with the industry. We probably, I would say, to some extent, we should go slower because we're in a hurry. The problem when you go in a hurry without much reflection is that this leads to accidents, and this is exactly what we're seeing. So the financial stability issues, precise financial stability issues that concern me the most are the contact points between the DeFi world that is out there with the traditional systems. A lot of that takes place through the exchange houses, the ramping up and ramping down of the system, and some leverage or some lending transactions where it is not very clear what is the collateral behind it. I think that we need to address them. I need to address them, but so far I think it is contained. I would say that the huge challenge, and I finish with this, the huge challenge that we face is that DeFi and the crypto world is global and is borderless, and therefore it requires huge amounts of coordination to bring this into an adequate regulatory perimeter that promises safety, but also allows for innovation. Thank you.
Thank you very much. It's a very stimulating introduction, I must say. Can I ask now our panelists to react, and perhaps also to come back to this issue of monetary normalization? Your image or your feeling was perhaps that these are more structural forces which are playing, and that monetary normalization only played a minor role. I oversimplify in the recent problems of the crypto world. But Jay, if you are ready to start, you are most welcome. And thank you again for being with us in Paris. In Paris, you cherish, I should stress it again.
Yes, and I'm sorry not to be able to join you, as you know, in person there today. So I would just begin by thanking you for inviting me to take part, and also by agreeing with with the take that Agustin articulated. To begin with your last question, I do think that the monetary policy normalization that we're seeing all over the world, all it did was simply reveal what we've long pointed out as significant structural issues in the DeFi ecosystem, and conflict of interest, and all of those things have been revealed, in effect, as the tide has gone out. So I don't think that's a particularly important part of the question here. Really, the question is that within the DeFi ecosystem, there are these very significant structural issues around transparency, lack of transparency, and I think Agustin did a nice job talking about them. So the good news, I suppose, is that the interaction between, from a financial stability standpoint, the interaction between the DeFi ecosystem and the traditional banking system and traditional financial system is not that large at this point. So we were able to witness the DeFi winter, but it didn't have significant effects on the banking system and broader financial stability. And that's a good thing. And I think it demonstrates the weaknesses and the work that needs to be done around regulation carefully and thoughtfully, and gives us a little bit of time. That situation will not persist indefinitely. Ultimately, that's not a stable equilibrium, and we need to be very careful about, and I guess we'll get to this a little later, but we need to be very careful about how crypto activities are taken within the regulatory perimeter. In any case, wherever they take place, as Agustin pointed out, there's a real need for more appropriate regulation so that as DeFi expands and starts to touch more and more retail customers and that sort of thing, so that appropriate regulation is in place.
Come back to regulation in our second part. Ravi, can I ask you a brief reaction also on this financial stability issue?
Yes, well, thank you, Francois, and thanks for the invitation to participate in this, and greetings to my colleagues, Agustin, Christine, Jay, good to see you. I generally agree with what Agustin and Jay have said. Let me add a couple of nuances. I would say it will be useful to distinguish the various components of what we call the crypto ecosystem. And I think the kinds of risks each of them pose and the kinds of benefits each of them pose and what they mean for financial stability will be quite different. So if you look at, say, tokenized assets, for instance, there are many banks experimenting with this. Basically, you express the ownership rights over an asset as a digital token, and cash and bonds, real assets, intangibles, carbon credits have all been tokenized. These in and of itself, I think, pose lesser risk, but they're not the predominant part of the ecosystem, unfortunately, although I think that's where the real potential lies. Then you have cryptocurrencies, for which I don't see any redeeming value, because they're meant to be used as a medium of exchange within the distributed ledger, but we have all seen how they've taken a life of their own outside and are posing a range of risks, some of which Agustin has spoken about, ranging from consumer protection, volatility in value, money laundering risks, and even financial stability risks if pushed to the extreme. And the speculation in these currencies has led to price changes that are nothing to do with the underlying economic value. And I think with the current monetary policy normalization process and tightening, it is, as Jay said, it's going to expose the excessive exuberance that has been attached to these cryptocurrencies. And I think they're going to be affected badly. In fact, all of us on this panel, I think in our own ways, have been saying this, the risks involved in investing in cryptocurrencies. But who listens to central bankers, right? And I'm afraid it's the time for reckoning has come. I'm a little bit more positive about stablecoins if they're done well. Basically, these are digital tokens whose value is pegged to another asset. And they can have a good potential as a medium of exchange because they're digital cash, they're programmable, can be put on the ledger, provided their value is fully backed by reserve assets. So the focus of regulation is quite different in stablecoins. If we can crack that problem through an appropriate regulatory regime, I see more promise for stablecoins, and almost by definition, they should, reflect the demand for underlying fiat currencies to which they're pegged. And so the impact of interest rates and all that would be really reflecting the underlying assets. So I think we need to make distinctions across the three. And DeFi is a totally different animal. All these things that we discussed in the crypto world can operate alongside the traditional financial system. In fact, many banks and traditional players are involved in these innovations. DeFi is a totally different thing. And I fully agree with Agustin, there is a lot of stuff that's unknown. I would just say the central problem is that even if you can address the other risks, the big risk is where are you going to apply the regulation to? Because all our regulatory approaches are based on applying regulations to legal entities. In a decentralized world, you can't do that to an algorithm. And pinning that governance and risk management responsibility on the players that can make a difference in the DeFi world is exceedingly difficult. And that's something, if we can overcome, I can see some promise in DeFi. Otherwise, this could be a game stopper. But I want to say that you don't have to go as far as DeFi. crypto assets and digital assets have a role to play alongside traditional finance. Some of them are working, some of them not going to work. And I think the current normalization phase in monetary policy is going to expose which are the ones that are promising and which are the ones that are purely speculative. Thanks.
Thank you, Ravi, and I'm sure the distinction you made between different animals will be useful when we will discuss more precisely regulation, as Jay mentioned. By the way, you use the word cryptocurrencies sometime, and usually we central bankers don't like that much the expression cryptocurrencies, because these are not currencies, these are crypto assets. But I'm sure we agree. Christine, do you want at this stage to intervene and react, or do you prefer to focus on central bank response in the second part? Please, you are very welcome. Bonjour.
Yeah, thank you so much. Bonjour, François, and thank you so much for having us. And I think it's very fitting, actually, that we discuss this enigmatic phenomenon that took the world in such a stormy way, right in the middle of the museum in the world that keeps probably the most enigmatic painting, Mona Lisa. So thank you for having us in the Louvre. It's just perfect. So just 3 points that I wanted to share with you, which I keep thinking of in relation to crypto assets in general and the impact it has had. First of all, the evolution has been stormy. It went from this sort of cultural hype pushed by libertarians, promoted by Satoshi Nakamoto in his wisdom and total anonymity, to being this tool that is now accepted by the PayPal, Visa, and MasterCard of this world, and which has been abused by, whether it was Terra or Luna, but certainly Mr. Do Kwon, who is on the run, is the other side of that enigmatic coin, which warrants the regulation that has been advocated by both Jay and Ravi. Second, where evolution has been critically important, is this search for yield, which has clearly encouraged and accelerated the process at times when across the world we were in the lower bound and where interests to be earned were limited. And third, the world was caught by surprise. And from these regular statements that we all made that, oh, of course it was growing, but it wasn't systemic. Well, we are now at a stage where, between 10 and 15% of Europeans and Americans actually have invested in cryptos in 21. And where clearly regulators, consumer protection agencies, supervisors are now really attentive to developments. So those are three interesting aspects: this cultural evolution, the search for yield, and the world caught by surprise that I associate with the development of cryptos, that I will go into further details in the second part of this session. François, thank you.
Very much to the four of you. By the way, a technical remark, there was some echo. I wonder if each of you can be on mute when you don't speak, but we could hear quite well. So we come to the second part about the responses by central banks to this landscape you presented to us, Agustin. Obviously, it calls into question an almost philosophical point, the relation along history between public and private money. And as all of you have said, it's a question of combining regulation and or innovation in our responses. So as I said, I suggest that our two prominent central bankers across the Atlantic, first Christine and then Jay, focus on their view on the topic. My understanding, and I say it with a smile, that, Christine, you intend to focus perhaps a bit more on innovation and CBDC, and Jay, you intend perhaps to focus a bit more on regulation. Perhaps people would have expected the US central banker to focus on innovation and the European one to focus on regulation, but at least it shows you that we are all on the same page of combining both. And Christine, if you agree, you start.
Okay, well, thank you so much, François. And very briefly, by way of introduction, the way it was, the disruption, and what we need to do, we central bankers, to stay ahead of the curve and be in the game. So the way it was and the way it is, in a way, is what you just alluded to, François. It's this combination of public and private money, public money being the matter for central banks, either cash for individuals or central bank deposits for banks, and private money, where commercial banks were the main player, making up around 85% of M1, and being innovative with new forms of payment, from giro payments to cards to any other things. And both of those, public and private money, actually complemented each other quite nicely. Then came the disruptors, and I could not agree more with Ravi about the distinction that we have to make when we analyze the way forward and the regulatory framework, where we have to distinguish between the crypto assets, the traditional Bitcoins, Ether of this world, and the stable coins. And where I totally agree with Ravi that the crypto assets, not currencies, but the crypto assets are obviously pure speculative assets. And I think that the movement that we have seen in the last 12 months is clear indication of the fact that it is indeed a speculative assets, and certainly not a means of payment, not a very stable store of value. That's one aspect. The second aspect, which is more promising, and I also agree with Ravi on that, is the whole sector of the stable coins, which only represent about 10% of the entire crypto universe. So it's very minimal for the moment, but it is promising as long as we don't have players that abuse the system, that pretend that they have liquid assets to back their stable coins, or that it's one for one when in fact it is not one for one, and Terra is followed by Luna bankruptcy. So that is possibly disruptive, but it is, for the moment, as I said, only 10% of this crypto universe that we are talking about. But it has created, and it has probably accelerated, the desire for more innovative ways of paying, more innovative ways of transacting. And as a result, digital payments are clearly in high demand. And this is more so in some countries, less so in others. Just to give you an example from Europe, in Sweden, for instance, there is virtually no cash transactions anymore because cash is not there. Whereas currently in Austria, there is a referendum to defeat a proposed regulation to request that payments be not in cash above 10,000 euros. Well, in Austria, they would like to be able to continue to pay more than 10,000 payments in cash. So there is great heterogeneity in the request, but we can see in the surveys that we have conducted that there is clearly an aspiration, a desire for digital payments, much more so than it was in the past, and this is growing. We are now, in the surveys that we've conducted across the 19 members of the euro area, we have more than 50% of the respondents who say, we want digital payments. Well, less use of cash, demand for secure and riskless payments. Where do we stand? We central bankers, we have been operating as a monetary anchor in relation to the commercial banks and the private money. If we are not in that game, if we are not involved in experimenting, in innovating in terms of digital central bank money, we risk losing the role of anchor that we have played for many, many decades. And we have historical examples of period where the central bank monetary anchor was not there, and that precipitated crisis after crisis. That certainly was the case at the time of the free banking in the 19th century. Do we want to go back to those days? Probably not. I would say certainly not from our vantage point, as a result of which we have to respond to the demand for those digital payments in order to maintain the role of anchor that we have been playing regularly. So what have we done here in Europe and with the whole Euro system, including all the central banks that are members, including notably the Banque de France, which has been very active, but also Banca d'Italia, Bundesbank, and a few others, but certainly all around the ECB. We have decided early on to start experimenting discreetly and try to understand the concept, the preferences, the media that could be used, and the characteristics that should be presented by the digital euro, as we call it. We're not the only one. Back when I started as president of the ECB, there were about 30 central banks that were looking at it. As we speak now, and I have nothing to do with it, the BIS, I think, has done an inventory of who is doing what in the zoo, and there's more than 100 central banks that are currently looking at CBDCs and exploring what characteristics it should have. So for us, it's the digital euro project. We will decide in about a year's time whether we actually move into a additional phase and prepare the post-prototype phase. We are now currently in the prototype phase, and we're certainly not ahead of the game because PBOC in China is ahead of us and a few others, but we are not doing badly in terms of timetable, and we are sticking to it. What I would like to do, François, is just very briefly go through the characteristics that we see as important. First of all, it has to be a convenient medium of exchange, that it becomes part of everyday's life for the Europeans. Number two, and why is that? Because customers, Europeans who have been surveyed, have indicated that they want to be able to pay anywhere and expect instant, easy, and contactless payment, especially person-to-person payments. Second, it has to be a success. It is not a venture that you can go lukewarm. You have to be 100% sure that it will actually work. You cannot fail on that one. There are pitfalls, obviously, and if a digital euro is overused, for instance, as a form of investment, it could crowd out commercial bank deposits and affect credit intermediation in the economy. So while we talk about DeFi, which is disintermediation essentially, and finance determined by protocol, the way we are thinking about it includes actually intermediaries and makes sure that commercial banks are part of the system. We also believe that there should be well-designed safeguards that either would include limitations to the holdings or would include a sophisticated tiering system in terms of remuneration in order to prevent that the digital euro become a very attractive investment more than a mean of payment. We want appropriate pricing and distribution via payment service providers because, as I said, it's not something that would be done in abstracto without the intermediation of the commercial banks or other private parties, actually. But certainly the pricing should be right. And all of that is intended for the retail segment of the digital euro, which doesn't mean to say that it would exclude, quite to the contrary, actually, a wholesale settlement infrastructures that is often referred to as the wholesale CBDCs. Actually, that in a way exists already, although in maybe a preliminary and not sophisticated enough form, but certainly the wholesale CBDC must be explored, must be part and parcel of the overall system. And I know this is something that, Francois, you feel strongly about, as I do. And the settlement infrastructure on which we operate, which has a dimension of digital about it, needs to be significantly upgraded and needs to be made more digital than it is at the moment. And in that respect, if the counterparties, if the commercial banks with which we operate expect distributed ledger technology to be part of the improved infrastructure payment, then we should certainly be open to it and be prepared to endorse the digital ledger technology as part of this improved infrastructure mechanism. So well advanced on our way and moving into, as I said, prototype phase that would precede the decision by the Governing Council to effectively move ahead with the project. Thank you, Francois.
Thank you very much, Christine, for sharing with us in such an open and clear way your thoughts and questions on CBDC, including how to work with intermediaries. And I'm sure it's of great interest for the participants in the conference. Jay, can I now turn to you? And you insisted rightly on the importance of regulation. I know that the Fed's research and reflection on stable coins, for instance, is of utmost interest. Jay, I only add that I cannot resist the temptation to invite you at the end, if you are ready, to say some words about CBDC also seen from the other side of the Atlantic, but up to you.
Thank you, Francois. And you've also given me a perfect opportunity to point out that we have a long and proud history, actually, on working alongside the private sector in support of responsible innovation that encourages efficiency, lowers costs, and brings better products to the public. We do favor responsible innovation, including in crypto-related services or products. I think back to the times when checks became obsolete in a lot of ways, and we were very much in the middle of fostering that transition. The Fed is also roughly a year away from rolling out FedNow, which is an instant payment system that will make instant real-time payments available to the public through their banks. So the whole point of regulation, of course, is to create a level playing field that will allow us to reap the benefits of true innovation while avoiding the pitfalls of regulatory evasion. So turning to regulation, I guess I'll make a couple of higher level points about the regulatory challenge that we all face, and then talk a little bit more about stablecoins, which I agree are to be thought of as quite different from unbacked crypto assets. So I guess the fundamental principle for all of us, is same risk, same regulation. Some of these crypto activities resemble traditional financial activities, and they need that. They need same risk, same regulation wherever they take place. There are also some novel activities, though, genuinely novel, that are really a paradigm shift. For example, replacing intermediaries with smart contracts or decentralized governance and control structures. And so these novel structures create potential new risks, and I think we have a lot of work to do on that. We've got a lot of work to do across both the more traditional looking parts of DeFi, but especially for the novel aspects of it. An example would be unhosted wallets, for example, which allow users to custody their own crypto assets. However, they can also be used to evade sanctions or engage in money laundering. And there are other novel aspects of it that are quite challenging. Not least, as I guess two of my colleagues have pointed out, the fact that this is a borderless world and just we look to regulate an entity. And as I think Ravi pointed out, if that entity is an algorithm, how do we do that? So there's a lot of work and a lot of thinking to do to determine what practices are acceptable, which ones are flawed and predatory, what can be done to address these problems. This is new technology. It certainly has the possibility to bring improvements and efficiencies to the financial system. We've got to realize, though, that in some cases, these apparent efficiencies are really superficial in the sense that the cost saving comes from ignoring risks or failing to maintain appropriate levels of assets and liquidity to deal with those risks in good time and bad, and from complying with laws. So those are some higher level points. On stable coins in particular, so as I think others have pointed out, most of the usage of stable coins now is on the crypto platforms. In effect, stable coins are a money-like asset that is used to settle transactions on DeFi platforms. But many stablecoin issuers are talking about it, and there's a great deal of interest, I think, everywhere among potential stablecoin issuers to reach the general public more broadly, including retail payments and that sort of thing. And I think so. That's really what our main focus here, from a regulatory standpoint, is should stablecoins be used in that way, much more broadly, much more public-facing, away from the crypto platforms? What's the appropriate regulatory structure? And we have a group of U.S. regulatory agencies under the leadership of the Treasury Department put together a proposal or an analysis and a proposal, and we encourage Congress to pass legislation, which we think is needed for this kind of stablecoins. I'm happy to say that the House Financial Services Committee here in the United States is working on a bipartisan bill. And that's a very constructive enterprise. I will say that from the standpoint of the Fed, the central bank, we think that the central bank is and will always be the main source of trust behind money. Stablecoins essentially borrow that trust from the underlying issuer, and in many cases, these are dollar stablecoins, so they're really borrowing that trust. These are private forms of money. They will be subject to runs if their reserves are not full of very high quality assets. So there's a regulatory job to be done there. We also think if you're going to have private money created across the country, really there needs to be a federal role. I would liken it to what happens with the dual banking system here, where there's a very important role for state regulators, but there's also a role for any commercial bank in the United States. There's also a role in licensing that bank to operate at the Fed or another federal agency. And in the case of this, which is money creation, we think it really should be the Fed that does play that role. So that's our principal focus now, I would say. Turning to your question, so cash is not disappearing here in the United States. We still use cash quite a lot. It is declining, not in absolute terms, but compared to non-cash payments, it's declining. And we're motivated by really what Christine was saying, to look very carefully at the potential costs and benefits of issuing a central bank digital currency here in the United States. So we agree that the central bank has always provided the stable, trusted anchor for the currency. That's really perhaps our most fundamental role as central banks, one of the most fundamental roles anyway. So we're looking at it very carefully. We're evaluating both the policy issues and the technology issues, and we're doing that with a very broad scope. We have not decided to proceed, and we don't see ourselves as making that decision for some time. We see ourselves as working in collaboration with both Congress, of course, but also with the executive branch, which brings expertise to many of the issues that we have to deal with here. And at the end of the day, we will need approval from both the executive branch and Congress to move ahead with a central bank digital currency. So we see this as a process of at least a couple of years where we're doing work and building public confidence in our analysis and in our ultimate conclusions, which, as I say, we certainly haven't reached yet. I guess I would just say that's where we are. We've got a lot of work to do. There are many more things to say, Francois, but I'll stop there.
Comments, in my view, about central bank money, trust, and stable coins were very enlightening. Do you allow me one further question, Jay? Listening to you, I was thinking that perhaps dollar-based stable coins are not that different from MMF, money market funds. Would you agree with this parallel? And could it mean that their regulation should not be that different from the regulation of MMF?
I think, Francois, that's a very reasonable observation. If you think about, and these are not the stable coins that are being used on the crypto platforms. This is a world in which stablecoins are being offered more to the general public. So they have aspects of bank deposits. You could say they have aspects of money market funds. And of course, both of those are very substantially regulated, and appropriately so, because the general public will look at, I think we know from our experience over time, they'll look at a form of private money like that, and they'll assume that it's money, that it's money good, that it has the central bank's backing, or something like that, so that they can trust it. And we just need to make sure that if the public is going to be facing and dealing with stable coins that carry that implication, that the reality is there. And I guess Ravi mentioned the reserves. The reserves need to be transparent, publicly transparent to the public, and they need to consist of the kind of credit assets that will always be there when there's a need to fund withdrawals, because otherwise the structure will be run-proof. And we saw that in the last few months in a couple of cases where stablecoins were not able to handle the withdrawals, and we saw it regularly with money market funds in the last two financial crises. In both of those cases, some of the money market funds were not able to, or really struggled to keep up, and the Fed had to step in and provide liquidity to that part of the market. So again, that's another form of private money, and we think it needs appropriate regulation.
Thank you. I now turn back to our two panelists, first Ravi and then Agustin, with at least two questions, but you are free as long as you remain brief, but you will be. First, about the regulation of the various animals, Ravi, you mentioned, including stable coins, looking at what Jay just said. And second, on the innovation side and CBDC, how do you see the respective importance of retail/wholesale CBDC? Because this is a debate Christine touched upon, but which, in my guess, could be rising in the next years. Ravi first.
Thanks, Francois. Let me try to address those questions in three buckets. The first bucket goes back to a point that you raised earlier between public and private money. So I want to first say, what is it about the crypto phenomenon that has changed that thinking? I mean, right now, most of our money is private money. It's called commercial bank deposits. And it works because it is anchored on public money, central bank issued money, the monetary base. And there are a few things that give this confidence and anchorage. One, regulation and supervision, capital requirements that protects the asset side of the balance sheet of banks, liquidity ratios, and a whole range of prudential things that prevent or try to minimize risk to banks. Second, the central bank stands as lender of last resort. That is what gives private money or bank deposits confidence. Third, deposit insurance. It covers most bank deposits up to a high level. So this is the anchorage that we currently have that allows private money to flourish and people have confidence. What is lacking here? This money is not programmable. This money cannot be put on a distributed ledger to carry out some of the use cases that Christine spoke about, particularly cross-border payment and settlement. You can't have atomic settlement or the mutual exchange of two assets in real time with existing platforms. You need a distributed ledger. You need money that is programmable. That's why there's demand for crypto or digital cash. Now, then there are four contenders for digital cash. First is CBDCs, which you raised. Central bank itself issues the digital cash. Second, you have stable coins. Private sector issues digital cash, but is pegged to a fiat currency. And our role is to make sure that peg is solid. Third is tokenized deposits. We haven't spoken about it. Existing bank deposits, a part of it could be tokenized and put on the ledger to carry out all these use cases and benefits. And the same protection that the banks have will apply to these in theory, at least. And that's something we regulators need to think about.
Oh, this is what about tokenization. Perhaps if you agree, Agustin, could you take the floor? Ravi, you have you back
so
in Paris, which is good news.
Coins, and
can I ask the technicians to try to settle the issue? And Agustin, if you are ready to react on this question of working. Can we have a call with Singapore and check how it works? Ravi, we will come back to you if you can listen to me, because we have a slight technical problem. Agustin will intervene and you will be back. Okay?
Okay.
On the regulatory issue, I think that there are many dimensions. One that we need to work it out is the coordination try to tackle the issue of borderless crypto and in a way like lack of the ability to identify which entities are doing what. Now, given said that, I think that we should not completely sacrifice to think about regulation both through have activity-based regulation and entity-based regulation. There are many entities in a DeFi, in the crypto world, that can be identified. For example, who establishes the rules of the algorithms? Who takes the decisions about stable coins? Those are centralized entities. As a matter of fact, what we have said in the BIS, there is an illusion of the decentralization. At the end of the day, they are quite well identified central players that can be regulated, and I think we should move in that direction. I also think that we should have the ability to question the universal application of same activity, same risk, same regulation. For example, a repo done for DeFi purposes by an exchange that doesn't have limits on capitalization, doesn't have liquidity rules, doesn't have leverage rules, they can do repo ad infinitum, without supervision of the collateral that is involved in a repo. Is a repo done in the DeFi context the same as a repo done in the banking system? For me, it's a very different animal. Therefore, I think we should have that flexibility. So big challenges there, and I think they're very, very important. And as a matter of fact, I fully support the view that Christine mentioned at the beginning, at the outset of her intervention. Search for yield, the blow of search for yield was a huge contributor, not the only one, as I said, for the deflation of the crypto world, but had to do a lot with the quasi-Ponzi scheme that was going on because of lack of regulation and abuse of figures like repos. So I think we need to have that nimbleness to do all this. Now, in terms of CBDCs, I think what Jay and Christine has said is precise. I don't have much to add, but I would build a little bit more in the direction of where Ravi was going, and that is, I think CBDC can really become programmable and can facilitate the incorporation into more traditional type of transactions of many of the ideas behind DeFi, like programmability and so on and so forth. So I think that the nimbleness that, for example, stable coins bring to the table should be provided by CBDC. And as a matter of fact, it shouldn't be that difficult. What does stablecoin mean? Stablecoin means it's a digital asset that doesn't have value in itself, and it has to import its value from trusted money issued by central banks. So, but if we have already trusted money, why do we need to export that value to another currency? Well, let's just present that money with the adequate technological representation that would allow for innovation and the evolution of the payment systems and the financial system in the way it is being pursued through DeFi.
And Agustin, I push the question on wholesale versus retail CBDC. If I was to be provocative, I would say that the BIS Innovation Hub, to my knowledge, is mainly focused on wholesale CBDC. Do you believe in retail CBDC? Yes or no?
I think it's a public choice. I think my basic point is it needs to prove its value. But one thing that we as central bankers, at least that's my opinion, personal opinion, cannot afford is if the public wants a central bank issued money for retail, we should be ready to provide it. I mean, if the society demands that, we should be able to provide it. I think we should do the work. If people do not want it, well, that's fine. But if people really want it, I think it behooves us to be ready.
Thank you. Ravi, we will turn back to Singapore. Sorry for this technical problem we have. By the way, I turn to the organizers. We will perhaps have 3 to 5 minutes at the end from 1 or 2 questions from the audience. So we will see if it's possible, but if you have questions, don't hesitate. Ravi, you are back.
Thanks, Francois. I'll just pick up from where Agustin left off. I'm a bigger fan of wholesale CBDCs than retail CBDCs. As I said earlier, the critical problems we're trying to solve can be solved by programmable money in the form of private stablecoins, tokenized deposits, or wholesale CBDCs. And I think the future landscape will have all three in play. And I think that's not a bad landscape, provided we can regulate stablecoins well, and the other two, will follow suit. Retail CBDCs, I think, is a public choice. it's not required to solve any specific problem that of the kind we're discussing, whether it's trade finance, cross-border payment settlement, post and pre-trade capital market activities. You don't need retail CBDC for that. Wholesale CBDC, stable coins, and tokenized deposits can do it. So retail CBDC is a separate choice. I think it's a political economy choice and a public choice. A quick word on stablecoin regulation, which I think is where the crux of our focus ought to be. And Jay has highlighted the things that we're doing at the international community level. I think there are three issues we need to pay close attention. Jurisdictional differences in stablecoin regulation, I think, can be very challenging. The thing is this, the same stablecoin can be issued by several entities across multiple jurisdictions. So the same coin issued in the US and issued in Singapore could be subject to different standards. And this is and so we do need regulatory alignment, and this is something the international community is focused on. Then there are the decentralized governance issues with stablecoins that rely on algorithms. This is a huge problem, and we discussed that earlier on. And then third, there is systemic risks. Now, we say that stablecoins are backed by low-risk assets. Now, if they're fully backed by low-risk, high-quality assets, they can pose concentration risks. In times of stress, multiple stablecoin issuers can concurrently suffer from massive redemptions, leading to a fire sale of underlying financial assets, because these are a limited class of financial assets which we regulators would deem as low risk and high quality. So I think this is one risk we need to look at. So, but these are solvable problems, unlike the DeFi problems, which are almost conceptually difficult at this point in terms of regulatory technology to try to solve. I'll stop here. Thanks.
Thank you very much. I just check whether Christine or Jay would want to have a short reaction to what Agustin or Ravi said. Up to you. No? Up to you. Okay. Then, if we can have a light on the audience and see whether there are some questions. I say it for our three online panelists. We have a wonderful audience in Le Louvre, about 400 participants, but I'm just checking. No question? Apparently there is one question, but do you have a mic? Here? It will come. If you just are ready to introduce yourself and put your question briefly, thank you very much.
Bonjour, David Durouchou, Société Générale Forge. My question is related to the anonymity of the coins that we are dealing with. Cryptocurrency are bearing a lot of anonymity, and probably it is the reason why a lot of people are using them. Would CBDC bear the same anonymity, and how do you manage it in the future?
I hope the question was clear for everybody. By the way, you use the word cryptocurrencies, which was the best way to stimulate the 5 central bankers who are here. But I don't know who would jump on the question. And